$81. Let that number sink in for just 1 second. Silver, the same metal your grandparents used to say was the poor man's gold, is sitting at $81.31 per ounce as of today, March 14th, 2026. The market opened this morning with silver spot at 81.12, gold pulling back alongside it, the US dollar flexing hard, oil prices surging, and the Fed standing its ground on rates. And yet, most people watching this right now have no idea what that actually means for their money. No idea what's happening beneath the surface. No idea that the very forces dragging silver down today are the same forces quietly building the case for one of the most powerful precious metals breakouts we've seen in a generation. If you've been sitting on the fence about silver, if you've been watching prices, second-guessing yourself, wondering if this dip is a warning sign or the buying opportunity you've been waiting for, then stay with me. Because in the next 20 minutes, I'm going to break down exactly what's driving today's silver price movement, what the gold to silver ratio is quietly screaming at us right now, and why the smartest investors in the room aren't running away from this pullback. They're leaning into it. Welcome back to Silver Signals, everybody. I'm Yali Jiang, and if you're new here, first of all, welcome to the channel. We talk about precious metals, real-world investing, and what it actually takes to build wealth that holds its value when the world gets a little unpredictable. If that sounds like your kind of conversation, do yourself a favor and hit that subscribe button right now. We put out content every single week, and today's video is one you're going to want to have saved. So let's get into it. Slight pause. All right, let's talk about what's actually happening in the market today, because there's a lot going on and a lot of noise, and I want to cut through all of it and give you what actually matters. Silver is trading at $81.12 per ounce as of the market open this morning. That's a drop of $2.80, about 3.3%, from where it was sitting. Now on the surface, that sounds like bad news, and I get it. When you see a red number, your first instinct is to be worried. But let me give you some context, because context is everything in this game. The primary driver of today's decline is a firm US dollar. When the dollar strengthens, and it's been flexing pretty aggressively this week, commodities priced in dollars tend to get cheaper in dollar terms. It's not that silver got less valuable. It's that the measuring stick got longer. Think of it this way. If you're measuring a piece of wood with a ruler, and you suddenly stretch that ruler, the wood looks shorter, but the wood hasn't changed. That's the dollar effect on silver, on gold, on oil, on every major commodity. Pause. And right now, that ruler is getting stretched. On top of that, we have oil prices surging, partly because of ongoing Middle East tensions, and that's adding to inflationary pressure in a complicated way. You'd think inflation would send investors rushing into precious metals, and under normal circumstances, it does. But right now, the market is doing something a little counterintuitive. It's pricing in the idea that the Fed won't cut rates anytime soon. And when rate cuts feel far away, the opportunity cost of holding non-yielding assets like silver goes up. Investors start thinking, why hold silver when I could hold dollars or bonds that are paying me something? That logic, right or wrong, is what's weighing on silver today. Pause. But here's the thing, and I want you to really hear this. Today's price is not the story. The story is what's been happening over the last several years, and where all of this is pointing. Let's zoom out for a second. Because if you're thinking about silver purely through the lens of today's tick, you're missing something massive. Since the beginning of the 21st century, silver prices have increased dramatically overall. We're talking about a metal that was trading for somewhere around $4 or $5 an ounce at the start of the 2000s. Today it's over 80. That's not a coincidence. That's not a fluke. That is a long-term structural shift in how the world values silver, and it's driven by two very powerful forces: the ongoing devaluation of fiat currencies and the explosion in industrial demand. Here's something I want you to think about. The US dollar has lost more than 90% of its purchasing power since the Federal Reserve was created in 1913. 90%. Pause. That means a dollar that could buy you a full meal 100 years ago will barely buy you a candy bar today. Now that kind of slow, quiet erosion, that's what precious metals protect you from. Silver doesn't pay you interest. It doesn't send you dividends. But it holds value across generations in a way that paper currency simply cannot. And more people around the world, not just in the US, but in Europe and Asia, across the developing world, are waking up to that reality. And then there's the industrial side of silver, which I think is genuinely underappreciated by most retail investors. Silver is not just a monetary metal. It's a critical industrial metal. It's in your solar panels. It's in your electric vehicle battery connections. It's in medical devices, in water purification systems, in electronics of every kind. The green energy transition, which is happening whether you believe in it or not, because billions of dollars are being deployed into it globally, is creating a structural demand surge for silver that has nothing to do with investors or speculators. Pause. This is real demand, physical demand, the kind that doesn't evaporate when the Fed makes an announcement. Now here's where I want to stop and actually ask you something, because I'm genuinely curious. Pause. When you think about investing in silver, what's your instinct? Do you lean toward physical silver? Coins, bars, rounds, something you can hold in your hands? Or do you prefer the paper route, ETFs, certificates, digital exposure? Drop your answer in the comments below. Seriously, I read every single comment on this channel, and I want to know where you're at. There's no wrong answer. Both strategies have their merits, but understanding which camp you're in shapes everything about how you should be thinking about today's market. So go ahead and drop that in the comments. And while you're down there, if you haven't already, smash that like button. It genuinely helps this channel reach more people who need to hear this information. Now let's talk about the different ways you can actually invest in silver, because this is where a lot of new investors get confused. Physical silver bullion is the most direct approach. You're buying the metal itself, usually in coin, round, or bar form. Government-minted coins like the American Silver Eagle or the Canadian Maple Leaf tend to carry higher premiums, meaning you pay more above the spot price, but they offer strong liquidity and wide recognition. Bullion bars and rounds, on the other hand, tend to carry lower premiums, which means you get more silver for your dollar. Pause. For investors who want to maximize their metal exposure per dollar spent, bars and rounds often make more practical sense. Then there's paper silver, ETFs, certificates, futures contracts. These give you price exposure to silver without you ever actually taking possession of the physical metal. A silver ETF is essentially a piece of paper, or these days, a digital record that says a bank or financial institution is holding a certain amount of silver on your behalf. Now, for short-term traders or people who want easy liquidity within a brokerage account, paper silver has its place. But I want to be direct with you about something. If your goal is to protect against systemic financial risk, currency collapse, banking instability, that kind of scenario, paper silver doesn't give you that protection. Because paper silver is only as good as the institution behind it. Pause. And if that institution is in trouble, your paper is just paper. I know some of you watching this are what the investment world sometimes calls preppers, people who are thinking about silver as a practical hedge, a potential medium of exchange in a world where traditional financial systems might become unreliable. And honestly, I don't think that perspective is as fringe as it used to sound. When you look at what's happened to currencies around the world over the last 20 years, Venezuela, Zimbabwe, Argentina, Lebanon, the idea of holding real physical assets doesn't seem paranoid. It seems prudent. Silver is divisible, portable, universally recognized, and it has thousands of years of monetary history behind it. That's not nothing. Pause. That's actually a lot. All right, now I want to get into what I think is the most powerful tool in a silver investor's analytical toolkit, and that is the gold to silver ratio. If you're not tracking this number, you should be. The gold to silver ratio is exactly what it sounds like. It's the number of ounces of silver you would need to buy 1 ounce of gold at current prices. Right now, as of today, March 14th, 2026, that ratio is sitting at 62.24. Pause. And it just moved up 1.61 points today, a 2.66% jump, which tells you that gold held up relatively better than silver during this pullback. Now, why does this ratio matter so much? Because in the modern free market era, the gold to silver ratio has historically traded in a range between roughly 50 to 1 and 80 to 1. Those are the guardrails. When the ratio moves significantly above 80, especially if it approaches or exceeds 90, it's historically been a strong signal that silver is undervalued relative to gold. It means gold has gotten expensive relative to silver, or silver has gotten cheap relative to gold. Either way, the ratio is pointing toward silver. Pause. And when the ratio drops below 50, the opposite is true. Silver has gotten expensive relative to gold, and gold starts looking like the better value. At 62 right now, we're in the middle of the historical range. But here's what's interesting, and this is where I want you to really pay attention. Pause. Earlier this year, this ratio was pushing toward the higher end of that range. It was flirting with levels that historically have preceded significant silver outperformance. And while today's pullback pushed it back up slightly, the underlying dynamics haven't changed. The industrial demand story is still intact. The monetary debasement story is still intact. The Fed rate situation, which is currently weighing on silver, is a short-term headwind, not a long-term structural shift. And historically, when silver breaks out of these consolidation periods, it moves fast. Pause. Very fast. I want to tell you about something that happened in 2011, and I think it's relevant to where we are right now. In the spring of 2011, silver ran from about $18 an ounce in late 2010 all the way up to nearly $50 an ounce by April of 2011. That's a nearly 270% move in just a few months. Actually, now, am I saying that's going to happen tomorrow? No, I'm not a fortune teller, and anyone who tells you they know exactly when silver is going to run is either lying to you or lying to themselves. But what I am saying is that silver has the capacity for explosive, powerful moves. Moves that leave people on the sidelines absolutely stunned, wishing they had paid attention when the signals were building. And that brings me to the part of this video that I think is going to genuinely change the way you think about today's price action. Pause. Here's the insight that most people miss, the one that rewards the patient, the informed, the investors who actually do their homework. Today's pullback in silver, the firm dollar, the elevated rate environment, the cautious risk sentiment, all of that is creating what sophisticated investors call a tension spring. Every time silver gets pushed down by macro forces that don't reflect its fundamental value, the spring gets compressed tighter. And springs, real ones and market ones, don't stay compressed forever. Think about what Middle East geopolitical tensions are doing right now. Even in today's down session, those tensions are providing what analysts are calling underlying support for silver, meaning even in a down day, there are buyers. Even when sentiment is cautious and the dollar is strong and the Fed isn't playing ball, there are buyers. Pause. That is a sign of a market with real durable demand beneath the surface, not speculative froth, real demand. And when that demand combines with the eventual turn in rate policy, which will come, it always does, and the ongoing surge in industrial consumption, and a gold to silver ratio that has historically reverted towards silver's favor, you're not looking at a market that's dying. You're looking at a market that's coiling. Now let's bring it all back to the beginning. I opened this video with a number, $81.31. That's where silver spot sits today. Per gram, you're looking at $2.61. Per kilogram, $2,614.18. Those numbers move by the second. That's the nature of spot pricing. Banks, financial institutions, dealers, retail investors, we're all watching the same live feed, all reacting to the same data, all making decisions in real time. And here's the thing about that constant price discovery. It means the market is always incorporating new information. Pause. Today's information says firm dollar, cautious sentiment, no Fed cuts on the immediate horizon. That's the information the market is pricing in right now. But tomorrow's information might say Fed signals a pivot, or industrial silver demand exceeded forecasts, or geopolitical situation escalates and safe haven flows accelerate. Each one of those scenarios moves the needle. Each one of those scenarios could snap that spring loose. A pause. And you want to already be positioned when that happens, not scrambling to buy after the move, already there. Here's what I want to leave you with today. Silver is not a get-rich-quick scheme. It's not a meme. It's not a speculation for degenerate gamblers looking for a quick flip. Silver is a multi-thousand-year store of value that also happens to be an increasingly critical industrial commodity in a world that is electrifying and solarizing and digitizing at an unprecedented pace. The same forces that put pressure on it today, a strong dollar, elevated rates, cautious sentiment, are temporary. The forces that underpin its long-term value are structural and durable. Pause. That's the distinction that separates investors from speculators. Investors think in years and decades. Speculators think in days and weeks. And remember the gold to silver ratio sitting at 62 today. Watch that number, bookmark it. If it starts climbing toward 80 or above, that's your market giving you a loud signal that silver may be significantly undervalued relative to gold. If it drops toward 50, that's a different conversation entirely. The ratio is your compass. Not a guarantee, but a powerful historical guide that has helped generations of precious metals investors time their positioning. Use it. If you found today's breakdown valuable, and I genuinely hope you did, please give this video a like. It takes you 2 seconds, and it tells the algorithm that this content is worth sharing, which means more people who need this information actually get to see it. And if you haven't subscribed yet, this is me personally asking you to do that right now. We cover this space every single week. Price analysis, market trends, investment strategy, the macro forces that affect your wealth, and I want you to be part of this community. Pause. This is Yali Jiang for silver.